As retail traders, we're constantly bombarded with half-truths and whole lies. The industry thrives by selling hope and appealing to fantasies. Does successful trading mean making 10% a year? Or 10,900% a day? Wouldn't it be helpful to have a professional benchmark to compare our trading performance against? I found an article on Hedge Week that references an annual hedge fund survey written by Global Investment Report. This report ranks the top 50 hedge funds of 2022 according to their most recent 5-year annualized return. Of course, there are some caveats when comparing the performance of retail traders and hedge funds. Hedge funds typically employ a wider array of strategies. They may have the best minds, equipment, and information. On the flip side, their fund size may make it difficult to enter or exit positions without moving the markets, and there may be trading restrictions or mandates or other operational challenges. With that said, let's dive into the report. I'll go over some salient points. The link is in the description so you can go over the report at your own time. The 2022 survey scans thousands of hedge funds across various databases, looking for broad strategy funds that don't rely on head or tailwinds coming from a specific industry or exposure. In addition, each fund has to be managing at least $300 million and must have achieved a minimum absolute return for each of the 5 years from 2018 to 2022. The minimum return was 5% for 2018 and 2019, 4.5% for 2020 and 2021, and -5% for 2022 owing to struggles in the equity and debt markets. The top 50 funds are ranked according to their 5-year annualized returns from 2018 to 2022. The average age of the 50 funds is 14 years. In top place, we have Hedge's Jupiter Fund, which raked in a sick 55% per year. Beside this, we have the annualized returns since inception. 25% annually since 1999 is incredible performance. The inception dates across the funds tends to vary a lot, so I'll just focus on the most recent 5-year period. Returns should always be compared to risk, hence there is a 5-year annualized standard deviation, which measures the volatility of returns. A lower value means more stable returns. If you subtract the risk-free return rate from the annualized return and divide the result by the standard deviation, you get the 5-year Sharpe ratio. Although Hedge's returns are the highest by a long shot, its higher volatility lowers its Sharpe ratio significantly. In fact, in the first quarter of 2023, the fund was down 44%. According to Bloomberg, the fund has been placing concentrated bets on rising interest rates in the US and UK, which have since gone south. If you scroll to 50th place, you see an annual return of only 5%, which I'm sure the vast majority of retail traders will scoff at. So what is realistic? Bearing in mind the caveats mentioned earlier, I think the performance of the 10th place fund is achievable for strong retail traders. 17% annually for 5 years, with a maximum drawdown of 14%, is certainly respectable. After all, if these funds are able to attract so much investor capital, they can't be doing that poorly. At the bottom of the table, you see the annualized return of the S&P 500 stands at 9.4% inclusive of dividends. Passive investing in broad-based market indices like the S&P have been all the rage recently, and it's easy to see why. Considering the low effort and skill required, the annualized returns are hard to beat. Even Warren Buffett famously said he wanted 90% of his estate wealth to be invested in the S&P 500 after he dies. Above that, we have the returns of the Barclay Hedge Fund Index, which charts the average return of about 3,000 hedge funds that report their monthly returns. By now it's common knowledge that despite their higher fees, most funds fail to beat market benchmarks. The average top 50 fund managed to outperform the S&P by 3 percentage points, with a correlation with the S&P of only 0.18. Indeed, having a trading portfolio across diverse markets, where you can go both long and short, can be a great addition to a buy and hold passive investment portfolio. During market sell-offs, the profits from short positions can stabilize your overall portfolio performance. In fact, the author states that even strong hedge funds cannot keep pace with bull markets that are fueled more by optimism rather than earnings. Instead, these funds perform much better during market sell-offs, contributing to the longer-term outperformance over the market indices. Hopefully this report gives you some insight into what is realistically achievable without dangerous money management methods like martingale or grid trading, which no rational investor would settle for. Trade responsibly, and thanks for watching.